Randall Krosner, Governor of the Federal Reserve from '06 to '09, now a professor of University of Chicago's Business School. Is the Vice President right when you've got inflation, core CPI inflation is what, 1.6 to 1.9, under the Fed target? Then could they lower rates?
Well, I would say, given the strength of the labor market, I'd be very wary of cutting rates at this point. I'd want to see if inflation continued to move down, and that's exactly what the Fed is waiting for. And precisely what you focused on before, Richard, is, I think, the right thing. Rather than focusing on just the particular month number, look at the average, and it's been about 200,000 jobs created per month since the beginning of the year. That is surprisingly strong, and that is a pretty strong labor market that we have.
Before we get into the politics, just stick straight with the economics. The number of 3.6% on the headline unemployment rate, was that because more people got jobs, or was it because that they left the workforce, they stopped looking?
So there was a little bit of both, but there were some people who were not looking as much as they had been before, and so we certainly would like to see more people in the labor force and more people getting jobs, because that will lead to more economic growth. But we've also been seeing productivity growth go up over the last quarter, and that's something that's helpful for overall economic growth, and also should translate into higher wage growth down the line.
The reality is, though, that at 3.6%, when you were doing your Economics 101, you were told 5 or 6% was full employment. If you had been told 3.6% with interest rates at 2.25 to 2.5 and unemployment at 1.7, you would have said this is nirvana.
Yeah, and clearly the world has changed. I mean, this is certainly very good, but it seems that we can sustain lower unemployment rates without generating inflation. It seems that we can have lower interest rates and not generate inflation than we have from before. But as you were saying before, Richard, there are a lot of forces outside of the Fed that are driving some of these things. And there are bigger forces about supply and demand for savings that are changing the underlying forces for interest rates, not just the Fed. So
fiscal policy is obviously bearing in mind what we're seeing with deficits. Deficits are going to rise quite considerably over the next few years. Does monetary policy, I know the Fed says short-term it's patient, but reality, they shouldn't be patient. They should still be in some form of tightening mode.
Well, given that there is very little inflation and very low inflation expectations, I understand why the Fed has sort of pivoted to patience. And I think that's going to persist for a while, because we're still seeing a strong labor market. We're seeing reasonable wage growth, not screaming wage growth, and we're seeing very little sign of inflation. So that's kind of what they're waiting for, to see whether this is going to translate into inflation pressure, which it hasn't.
Right, but Randall, the hawks always say by the time inflation arrives, it's too late to do anything about it. Now, we have seen good growth, but this is the first time we've really seen a strong succession periods of quarters of 3 to 3% plus growth for some time. So are you worried that there will be inflationary pressures, that inflation is not anchored at these lower levels?
So I think that's why it's very important that the Fed be patient rather than be cutting right now, because there is a chance for that. This is sort of somewhat uncharted territory to have these the unemployment rate where it is, have inflation where it is, have interest rates where they are. And so I think being patient but being vigilant and looking for signs of inflation is important, but also being vigilant and looking for signs for inflation declining. Other countries have had reasonably good job markets, but declining inflation. We don't want that either.